Exercise 611 is another perpetual inventory problem. Remember, perpetual inventory, you make every attempt to keep your inventory numbers current. So when you buy inventory, you increase the inventory account. When you sell inventory, you reduce the inventory account. Well, on August 6th, we purchased 70 games, 70 handheld games at $200 each, and that's $14,000. So debit inventory $14,000, credit accounts payable $14,000, and let's make a note of our terms. It's 110 net 60. So if we pay within 10 days, we get a 1% discount. If not, the whole amount is due in 60 days. Then on August 7th, we paid $400 for the shipping. Well, $400 was the normal, reasonable, ordinary cost to get the goods sent to us, so that gets added to our inventory. So we put $400 shipping and $400 credit to cash. Shipping, remember, shipping in, freight in, is always added to inventory. Freight out is a selling cost. Now, on August 10th, we had some units that were defective, so we sent 6 of them back. So we're going to return 6 units. So that's 6 units at $200 we're returning. So that's $1,200. And we reduce our inventory by $1,200. We owe them $1,200 less, and we have $1,200 fewer games in stock. Now, on the 14th, we pay what we owe them. Well, we originally owed them $14,000 minus the $1,200 that we sent back. So that comes to $12,800. But we are clearly within the 60 days. We're barely 10 days, 8 days later. So we're entitled to a 1% discount. So our entire accounts payable goes away, $12,800. 1% of that is $128. That's our reduction to inventory, because that reduces the amount we paid for the inventory. So we reduce that, and our cash is $12,800 minus $128. That's $12,672. Then on the 23rd, we sold some games. And remember, with perpetual inventory, when you have a sale, you always have 2 journal entries, one to record the sale and one to record the reduction of inventory. So our accounts receivable, they tell us we sold 50 games for $220 each. So it's 50 times $220. So our accounts receivable is $11,000, and our sales revenue was $11,000. And then they tell us that the total cost of the 50 games was $10,212.50. So we reduce our inventory by $10,212.50, and we increase our cost of goods sold. So when we purchased the goods, we increased our inventory by the full cost, and we increased our accounts payable. We increased our inventory by the shipping, the freight in. So this increases our inventory, this increases our inventory, this decreases our cash, because you spent $400, you have $400 less. Now, we returned $1,200 worth of units, 6 units at $200 each. That reduces our accounts payable. That reduces our inventory. Now we're going to pay the remaining $12,800 that we owe them. So the entire accounts payable goes away. However, we don't have to pay it all because we get our discount of $128, which reduces the value of the inventory, and the balance, the $12,672, was a reduction to our cash. Then on the 23rd, we sold 50 units at $220 each. Our accounts receivable goes up, our sales revenue goes up, and because we sold them, we also have to recognize our cost of goods sold. So our cost of goods sold goes up, but the value of our ending inventory goes